Welcome to Trends with Benefits, a podcast by Van Eck with a forward-looking perspective. We explore new ways of thinking about the markets, investing, work, and life. Here's your host, Ed Lopez.
Welcome to another episode of Trends with Benefits. I am Ed Lopez, and speaking of trends, we are going to talk about identifying trends with technical analysis with our friend JC Parets of Allstar Charts. JC, thank you very much for joining us.
Sure, happy to do it. You know that.
Yeah. So you're a chartered technical or a chartered market technician and founder of Allstar Charts. Can you maybe start out a little bit talking about what a CMT is, and then we can go into Allstar Charts as well?
Yeah, it's a great question. The CMT is a series of exams that's put on and organized by the CMT Association. Similar to the CFA, where the CFA has 3 levels and it's all fundamental analysis. The CMT is all technical analysis. So for me, it was early in my career, 23, 24 years old. Quickly, I learned that I needed to actually learn something if I was going to be good in this business and sort of improve my knowledge, because they don't teach you this stuff in college. So I was like, all right, so I hit that fork in the road. I was like, all right, do I want to learn fundamental analysis and learn about companies? Or do I want to learn about technical analysis and learn about stocks and the market? And at the time, it seemed like technical analysis was the logical choice. But little did I know how much that would impact my career, obviously, but really the rest of my life.
And briefly, the difference for the uninitiated of technical and fundamental analysis, technical looking at price trends as opposed to the book value and fundamental financial records of a company, correct?
So I think that what makes technical analysis great is that for us who use it, we know that we're not smarter than the market. I personally think you have to be a fool to think that. So the way by looking at it from a fundamental standpoint, what you're trying to do is you're trying to figure out where the market is wrong, when as technicians, we're always, we got the market's back. We know the market's right. And we're trying to figure out what that information is going to give us. So it's the other way around. So we're not looking for, like right now when it comes to the virus, it's like we're not looking for solutions for the virus. We're looking at the market to tell us how bad the economy is going to get, right? So that's how we look at things, not just from a market, but really in life. People, me, I wonder, how bad is this going to be? Well, I look at the market and the bond market, and they'll tell me.
It's the markets via the price is kind of a reflection of everybody's take on the market as a whole, right? Is that one way to look at it?
It takes all of the known and unknown information all over the world, from insiders and not, and the price of a stock or the market, where it is on a given day, is what it's worth, right? Earnings are, they're just estimates, right? They get revised. GDP numbers, unemployment, all that stuff gets revised, and we know that they're going to get revised, right? It's not a secret. But if the shares of Microsoft trade at a certain price on a certain day at a certain time, that will never be restated. That is fact. So when we study only fact, it's if you're not, right, it's garbage in, garbage out. So if you're making decisions based on estimates and guesses as opposed to fact, I think that that probably sets you back.
So let's talk about Allstar Charts. That's your current enterprise right now. What is the mission of Allstar Charts?
We provide technical analysis research for anybody who has to put money to work. And we're talking from everyday investors that are doctors and engineers to new students to the largest institutions in the world, the biggest hedge funds and banks that, are all household names, and everybody in between. So we do really well with financial advisors, particularly with this mass exodus from the wirehouses. Not that there's so much research at the wirehouses these days anyway, but when you go independent, you're really on your own. And obviously, you want to talk about trends. That's obviously been a huge trend. So rather than, if you have less than 500 million in assets or 400 million in assets, it's hard for you to bring in a technical analyst, let alone a whole team of technical analysts. When for a few $1,000s a year, you can hire us. That sits much better on the income statements and balance sheets.
So you're working with financial professionals as well as individual investors and institutions, kind of across the board, it seems.
We pride ourselves in institutional level research. I mean, there's no question the work that we put out, I think, is up there with the best of them. But we're able to explain it and put it out in a way that literally any investor can use it, right? We don't try to overcomplicate things. We actually do the opposite. We take things that theoretically are super complicated and we explain it in simple ways, really selfishly, because that's how I like things.
Yeah,
Simple.
me too. Simple is better. Let's talk a little bit more about Allstar charts and technical analysis. Can you describe your form of technical analysis? Are you a point and figure guy, moving averages guy? Maybe help explain some of the differences that might be out there.
I'd say probably neither of those two. I mean, I know of these very well. I was tested on them a long time ago, but I don't really incorporate those things in my day-to-day practice. I would say, me personally, I'm more, and our firm for that matter, and our approach is more of a top-down approach. So when you talk about, okay, JC, let's talk about the stock market. To answer your question about the stock market, the first thing we're going to do is we're going to talk about the bond market, and we're going to talk about the commodities market, and we're going to talk about the Forex market.
Let's talk a little bit more.
And then we're going to talk about every other stock market in the world, and we're going to have that conversation first. And then we'll be like, oh, okay, you wanted to know about the S&P 500? Okay, so now within that framework, this is where the S&P 500 fits. And then we'll break it down from there, and we'll look at the small caps, mid caps, the NASDAQ, the New York Stock Exchange Composite, the geometric averages like Russell 3000, S&P, I got more indexes than you've ever heard of on our list, right? That's just how we approach the markets. Then we'll look at each individual sector. So if you're asking me about Canadian stocks, there's probably going to be a lot of natural resources in those sectors. If you're asking me about American stocks, a quarter of the market is technology. So we have to be aware of the weightings. In America, we don't have bull markets without financials. So financials are obviously very important. The sector with the highest correlation with the S&P 500 historically is industrials. So another very important sector. So then we look at the most important sectors and then the components within them. So if you're talking about financials, let's say, we can't just group them all on their own. You got broker dealers, and you have insurance stocks, and you have regional banks, right? You have all different kinds of financials. In healthcare, you've got medical devices, which are basically tech stocks. You've got pharmaceuticals, biotechnology, managed health. So you have industry groups within the sector, and then ultimately at the stock level itself. But by the time I tell you, hey, we need to buy Microsoft or we need to buy JP Morgan, 95% of the reason why we're doing that has nothing to do with the chart of Microsoft or JP Morgan. It has to do probably with the fact that we like stocks as an asset class, and we like large caps, and we like technology, right? And it fits within that. And then the best risk reward opportunity to express that given thesis just so happens to be in Regions Financial or
across all those different asset classes. How do you determine the best risk reward? How do you rank, 1,000 different indices or different charts that you're looking at?
Well, the first thing that we want to do is first identify what type of market environment we're in, right? So the stocks we were looking for, what I would have ranked as high or whatever it is in the fourth quarter of last year, and how we're looking for stocks today is completely different. If you're looking at the new 52-week high list or the new all-time high list, you're looking at the snow report in the middle of summer, right? That doesn't make any sense. That's a lonely list, right? Not much information there. But in the fourth quarter last year and in the third quarter last year, part of the reason why we were so bullish was because we were seeing an expansion of stocks making new 52-week highs, an expansion of stocks and sectors and indexes around the world breaking out to all-time highs. Those are bullish characteristics. That expansion of breadth is bullish, right? The most bullish thing a stock can do is go up. But today, we're not looking at any of those things, right? We're looking at the new 10-day high list. We're looking at the new 21-day high list, 63-day high list. So our approach has to be dramatically different because we're in a very different environment. In the fourth quarter and third quarter last year, we weren't looking at the new 52-week low list. There weren't any 52-week lows, right? Now those are the data points that we're looking at, seeing fewer sectors making new lows, fewer stocks. So first thing we want to do, like I said again, is identify what type of market environment are we in from an intermarket complex, not just stocks, but including volatility and fixed income and credit and commodities and all of those things. And then we decide, okay, what tools are we going to overweight? Right now, we think, we're in beginning of May. we think the stock market is in a range-bound environment. So your trend following tools are probably not going to be very good, right? Because we're not in a trending market, right? Meanwhile, if you in 2017, for example, when the S&P went up the whole year, if you were using your mean reversion strategies and you were selling over bot conditions, you were getting killed, right? Because you were trying to use strategies that are good for range-bound markets in a trending market. So that's really how we break it down and then figure out, okay, this is the environment we're in. What's the best strategy to take advantage of
So
it?
it's adaptive depending on the environment. You're using a lot of different charts to help make a decision. Are you looking at different time frames as well, or do you look at monthly charts, daily charts? How do you break it down?
Exactly. That's exactly right. And I find it to be such a huge advantage. Some people, obviously I get all the pushback that every technician's ever heard, because I'm out in the public eye. So I hear it all, and I've heard everything before. A great one is that fundamental analysis is for the long term, technical analysis is for the short term. It's like, no, you idiots. It's the opposite. Technical analysis, the longer the time horizon, like the more reliable and helpful it is actually. So it's actually the opposite. So we start with the longer term view, because remember, what did we say? Why does technical analysis work? Because markets trend. So at the end of every month, we look at the monthly charts, right? Never in the middle of the month, only at the end when the candlestick is complete. And what that does is that it forces you to take a step back, and it forces you to identify the direction of the primary trend, which day to day, what did Dow do today? Oh, what did Yellen say? Or, whatever. It's easy to get lost in the day-to-day noise. That monthly chart review, from the bottom of my heart, it takes me 30 minutes. It's 12 times a year. That's 6 hours. That is the best 6 hours of work I put in on an annual basis by a long shot. I promise you. And then we go to the weekly charts and the daily charts. And I don't go under that because the 1 minute charts give me a headache, get me dizzy, all the letters, all the, the lights flickering back and forth. No, thanks.
So as a technical guy, and I think you already mentioned it, do not take into account fundamentals at all. So don't really care what the Fed is doing, don't really care what the company's doing, just kind of what the price action is, right?
Thank God.
Makes it simple,
imagine.
Right? Yeah.
Oh my God. Imagine if I had to worry about what the Fed is doing. I couldn't. Where do I even start? Where am I going to go find out what the Fed is thinking? Oh my God. No.
Tell me a little bit about maybe your opinion in terms of different strategies, maybe how they worked going into this latest downturn in February and March. How do you think technical analysis did, and maybe it really depends on what method you use or approach you take, did in either picking that up or sidestepping it, and thinking through that?
Yeah, listen, I've said it before. I'm not afraid to say it again. This crash came after more warning signs than any crash in the history of the U.S. stock market, or any country's stock market for that matter. The intermarket complex was quite obvious. As the S&P 500 was making new highs into February, we were already seeing bonds breaking out, interest rates rolling over, not to mention the breadth deterioration. People talk about the top in the stock market like it was February 19th, because that's the day the Dow peaked and the S&P, but the market really peaked on January the 16th, right? That's when the list of new highs peaked. So by the time those large cap indexes made their ultimate highs, most stocks had already made their highs over a month before, number one. Number two, on that last thrust in the S&P, transports didn't make new highs. They were already rolling over. Small caps, mid caps, micro caps, the value line geometric index, they were already making new lows. In fact, the regional banks peaked in December, and by mid-February, before the S&P 500 made its new high, regional banks were already making, get this, new all-time relative lows. In other words, the lowest value ever in the U.S. regional banks index relative to the S&P 500 was made before the S&P 500 peaked. So, when you talk about the amount of evidence pointing to get the heck out of the stock market and buy bonds and load up on cash, listen, I've studied every stock market in history. I think simply based on the fact that we just have more data now than ever before, I feel like it has to be the crash with the most warning signs, right?
Yeah, that's all. I didn't know that. Those are some great stats. And
I can keep going if you want.
tell me about, I mean, you're a Fibonacci guy. Tell me about that and how you apply, and maybe explain what Fibonacci is in technical analysis.
Yeah, I mean, listen, there are levels that the market tends to respect on the way up, on the way down. How it respects it, or if it doesn't respect it at all, is information in and of itself. These mathematics go back to India in 200 BC. The Italians love taking credit for it. Leonardo Fibonacci did great work. It's funny because Pingala in India 1500, 1400 years earlier discovered this in a completely different manner, but two really intelligent people, an Italian guy and an Indian guy, came to the same conclusions, two completely different ways. So it's fascinating from a math nerd perspective. But it really is just amazing how often we see these numbers in nature. I personally am in the camp that maybe us as human beings aren't intelligent enough to quite figure out what it means and why we keep seeing it all over nature. It's amazing. But what I do know, and my bigger concern, is how the market relates at those levels. And I mean, I could give you thousands of examples of the market, either stop going down or stop going up at these exact levels within a penny or two, time and time again. And when markets ignore these levels, evidence of overwhelming strength, or in some cases weakness. And a lot of these energy stocks, these Fibonacci extension levels were literally getting skipped over like they weren't even there. And that is evidence of just overwhelming selling, right? Which you don't need Fibonacci to tell you that that's what's going on. It's just further evidence that, oh my God, this is what's going on. You look at, some of the parabolic upside moves, and you'll see that these Fibonacci levels were skipped along the way, right? So it's not like, oh, JC says the market needs to stop here. Like, no, you take these levels and then you put those levels within the context of everything else that was going on. So, like, for example, at the beginning of February, technology hit its 161.8% extension level of the entire decline from the 2000 bubble peak, right? The entire decline to '02. So that was our target upon the breakout a few years ago. I mean, I'm on the record saying that was our target a zillion times. So what happened at the beginning of February when technology hit that target? I said, okay, mission accomplished. See you later. Now it's somebody else's problem, right? And I jokingly made the title of the report, Ancient Mathematics Says Sell Tech, right? Just to get a chuckle from my math nerd friends. And although, yes, technology hitting that level was one of the bigger reasons why we wanted to sell tech, it came within the context of the breadth deterioration we were already seeing, financials rolling over, right? Like, selling tech made sense in an environment that we're selling other stocks and buying bonds, right? So it's a holistic weight of the evidence approach.
Yeah, it's awesome. It's pretty interesting. I like looking at that, and it's based on the golden rule, I think, or the golden number, or something like that. The golden ratio.
Golden ratio.
Yeah. Nature of numbers. It's pretty interesting. You mentioned earlier your monthly charts, and I think you just put out your charts to watch for May. Maybe we can talk a little bit about that. Maybe some of the trends that you've seen there. Anything stand out to you in particular in your chart pack that you put out this month?
Yeah, they're a hot mess is really probably what stands out. To quote the great Crash Davis, he was the catcher in Bull Durham, and he said that sometimes you win, and sometimes you lose, and sometimes it rains, right? So when it comes to the market, it's very similar. Sometimes they're going up, sometimes they're going down, and sometimes it's one big hot mess, right? And I think it's important to recognize that, like we discussed earlier, right? We can't just take a strategy and just force that strategy upon any environment and try to put a square and fit it into a circle, right? It's just not going to work. First, identify the trend. I'm glad you asked me what was the big, what came out of it at that fantastic 30 minutes that I'm always, telling everybody about. To mass, we're below overhead supply in a lot of major indexes. The laggards are lagging, the leaders are leading. We're nowhere near lows, we're nowhere near highs, and we're just middling around.
And what about one of our favorite topics at Van Eck, gold miners, maybe gold miners to gold bullion ratio. What do you look at there?
I am all day long Van Eck gold miners. You kidding me? I've been waiting for this damn base to complete for years. I mean, there are so many gold miner junkies out there. In Canada, they love it. In Vancouver, they can't get enough of this stuff. I mean, it's just fascinating. So like, no matter if gold is going up, gold's going down, it's a mess. It doesn't matter. People are always asking me about the gold miners. And I've been saying if you ask anybody, I've been saying the exact same thing. Until it breaks 31, there's no reason to bother. There's no reason to bother. And that helped us avoid a lot of headaches for a while. But guess what? We're now above 31. So if we're above that, I think we get into the low 40s for sure, and then ultimately retest those all-time highs and get into the 60s.
Follow that trend. And what's your favorite asset class, just outright? Favorite relative trade currently?
Like in general to analyze, or like today, what I want to buy?
Today.
My favorite asset class, can I cop out and say cash?
No, that's all right.
You know what I'm saying?
If your charts have informed your opinion on that, great.
I really like cash. When things are a mess, I think there's a time to invest and a time to build wealth. And I think that there's a time to protect wealth. I mean, that's just market cycles. And if you've taken 5 minutes to analyze the history, and if you haven't, I encourage you to do so. There are just periods where you look back and it's like, man, that would have been a great time to have a ton of cash. And I just think that this is one of those times. If some people don't have the luxury to be in cash, a lot of our clients, for example, can't be in cash. So they have to be allocated somewhere. Those are just their mandates, just what it is. So if you have the opportunity to be in cash, think of it as an option. If you don't, I like precious metals. Like I said, I like GDX if it's above 31. If not, it's somebody else's problem. But if it's above 31, it's your problem, actually, technically. So if it's above 31, I'm in. And not just buy GDX, but look further, because we've been buying individual gold mining stocks. Newmont, for example, great relative strength outperformer. But now that GDX is above 31, now it's like, okay, now we're not just going to be super picky. Now we're going to look at that space from a broader standpoint. So it changes our approach if GDX is above 31, not to mention we can just own GDX. Also, if the junior gold miners start to outperform the GDX, so in other words, GDXJ starts to outperform GDX, to me, that would be evidence of risk appetite in the gold mining space, which is consistent with higher stock prices as far as I'm concerned.
All right, let's talk about some fun stuff. That was fun too, but let's talk about the happy hours fun stuff. I didn't mean to downplay that. But wine, man, let's talk about wine. I see you tweeting a lot about different wines. I hear you're a sommelier. Is that right?
Yep. So I passed the certified sommelier exam. It was, a long time coming. It wasn't easy. I bombed the hell out of it a year prior. I didn't quite study. I was just in Vancouver. Speaking of Vancouver, I was just in Vancouver to go skiing in Whistler, and the Court of Master Sommeliers was there and offering the exam. And I was like, oh, I'll sit for it. Worst case scenario, I'll just learn the process. And maybe I'll pass. Who knows? But no, I did not. I actually, I passed the blind tasting. So I was good at that part. And then I bombed the theory. And then this time around, I passed it all. So it's exciting.
Is there anything about what you do professionally on the technical analysis side that informs your either buying habits or tasting habits in wine?
Yeah, actually, it's funny because I learned very quickly that sommeliers are technical analysts. They use a weight of the evidence approach. That's the first thing that stuck to me. So like, for example, some people, the flaw of blind tasters, mine as well, it's just a human flaw. You look at the wine, you see the color, you're like, that's a Syrah. Right? You haven't even smelled it or tasted it. You're already you're making calls on what it is. Same thing in the stock market, right? A stock breaks above a moving average. It's like, okay, buy it. Wait, what about everything else? You know what I mean? Like there's a lot more analysis to do before you could say this is a buy, this is a sell, this is a Pinot Noir, versus this is whatever it is. So it's also deductive. So when you see a stock making higher highs and higher lows, making new all-time highs, it's not in a downtrend, right? By definition, it's not in a downtrend. So it's either an uptrend or a sideways trend, right? When you look at wine, if it's a red wine, it's not a Chardonnay, it's not a Sauvignon Blanc, right? So you can just cancel out of those right away. And then you see a little bit, it's a dark wine with a lot of color. It's like, okay, well, it's not a Pinot Noir. It's not, so you can just start knocking them off until you're left with, all right, this is either a Nebbiolo or a Sangiovese, and then those you're left to, and then so then you smell it and you're like, you taste it, it's like, oh, this got more tannins. Oh, this, and then you're like, okay, it's a Nebbiolo 2014 Piedmont, right? So like you're breaking it down, and we do the same thing in the stock market.
So let's bring it back to the Fibonacci. Tell me a little bit about Chateau Fibonacci.
So Chateau Fibonacci is a project we've been working on for a while. After living in New York City for 15 years, I spent almost 5 years living in Sonoma. I actually just moved back to the East Coast a few months back, but I was out in Sonoma for almost 5 years, and a lot of my friends were winemakers. So, I got a lot of free booze, that's for sure. But I really learned the ropes, not to mention that I'm a sommelier, so you have to study a lot of, viniculture and all that stuff. So I'm familiar with the inner workings of the process, not to mention some of my friends are experts, including my partner, who grew up in Calistoga. We have an acre and a quarter there. We call it Leonardo's Vineyard. And we're making 250 cases of premier Cabernet Sauvignon. It just so happens that this particular property is in the most perfect area you could imagine for Cabernet Sauvignon. And really the only areas around the world that are even comparable to where our fruit is growing is probably the left bank of Bordeaux and maybe Coonawarra in Australia. But that's it. I'd put us in the top 3 locations for this particular varietal on Earth. Maybe even the Milky Way.
That's awesome. So we wanted to offer some of our listeners a little special feature. We wanted to get your take for 3 recommendations for quarantine wines.
Well, if you live in a cooler climate and you'd like something to, warm you up, we were just talking about Barolos in my example. If you like a big, bold, tannic wine, these Barolos are beautiful. If you like that, the Brunellos are actually aged longer. It's going to be made out of Sangiovese, so they're really going to have a bite. Get yourself some oxtails or a ribeye or a pasta bolognese or something like that, something nice and hearty, and get that wine. If you're in a warmer environment and want something cool, a German Riesling from the Mosel, nice high acidity is going to be beautiful. And then if I got to add one of value, drink from the Languedoc. In the south of France, they're doing a lot of, they were making sparkling wine before champagne was. So those are the real gangsters down there. You get great buys down in the Languedoc, and drink Sonoma Cab. Napa gets all the credit. I'm making Napa Cab, so right, here I am spinning it myself. But drink Sonoma Cab. It's great. It's going to be less tannic. It's going to be more approachable from a price standpoint and from a drinkability and ageability. You don't have to age it for 2 decades. You could just shut up and drink it. A little cooler. Sonoma Moon Mountain Cab.
Excellent. Thanks for that. Let's talk about trends broadly. What is one trend that you see playing out over the next year or several years? It could be asset class trend. It could be consumer trend. It could be whatever trend that you think is important to watch.
I got to tell you, I've gotten a front row seat to the growing interest in technical analysis. If you want to talk about an uptrend, it is absolutely out of control how much thirst for knowledge there is out there in analyzing the behavior of the market. And we see it from the fundamental community as well. One of the fastest growing areas of current CMTs, sitting for the CMT exam, I should say, are current CFA charter holders. So everyone is seeing the value in analyzing price, number one. Number two, there's no right or wrong way to do it. It's not like technical analysis is like a job. Technical analysis is a tool, right? So any market participant, whether you're the biggest institution in the world or whether you're a college kid, who's first learning what compound interest is, God bless that young kid. Hopefully he sticks to it, and everybody in between who needs to allocate capital, which is like a large percentage of us. Understanding the way the market works and what drives supply and demand, I think, is an incredibly useful tool. I couldn't imagine analyzing markets or putting money to work without using some of these tools or as many of the tools as we use. So if you're going to ask me one trend that I am willing to bet everything on, it's just growing interest in technical analysis all over Asia, the Philippines, Kuala Lumpur, Singapore for sure, Hong Kong, obviously, Taiwan. I mean, I've been to all these places. I've given presentations in all these places. I mean, we had standing room only at the Bloomberg in Mumbai. 250 Indians there watching me rip through 150 charts. They thought I was crazy, but they loved it. You know, it was fantastic. They had really never seen anything like it. It was fascinating for me to see. The interest that I've seen in London, obviously, as you can imagine, but not just there, in Athens, in Dublin, in Amsterdam. I mean, just all these places that I've spoken. And then obviously in America and Canada, you know, Toronto, Vancouver, New York, Chicago, Dallas, Houston, LA, San Francisco. I mean, you know the names. I've spoken to pretty much all these places at one point or another, and the interest is out of control. And we see it from where our traffic is coming from, who our clients are, you know, where they're coming from, what they're doing. These are PMs from any country, every major city you've ever heard of. And you know what's really cool is that because I started a blog 10 years ago, thank you, Josh Brown, Howard Linson, Phil Perlman, you know, the guys that made sure that I was writing 10 years ago, because I listened, I have friends in all of these cities around the world. So if there's a college football game that I want to watch in Texas, I got a ton of friends that I could call. Hey, what's the best steakhouse? Where do I get this? Where should I stay? You know, if I'm going to Amsterdam, it's like, okay, JC, you need to eat at this Indonesian restaurant. You need to stay at this place. I mean, it's fantastic. I mean, it's really, what a blessing.
Yeah, absolutely. All right, now we're going to do Trend or Fad. It's our Trend or Fad segment. It's kind of our speed round. I'll ask you a few concepts, and you can tell me whether you think it's a trend or fad. This rally off the March 23rd low, trend or fad?
Fad.
Boxed wines, trend or fad?
Trend.
Coconut flour, trend or fad?
Trend.
Moving averages, trend or fad?
Trend.
You hesitated there.
Well, it's not a trend for me, but I'm seeing more and more people use them.
And oxtails, trend or fad?
I hope it's a fad because I love oxtails and I don't want prices to go up, and I study supply and demand. So like the fact that like I talk to people about how oxtails are like my favorite thing in the world. They're like, you eat oxtails? I'm like, yeah, you shouldn't try it. Don't worry about it. Don't worry about it.
Don't try it. They're delicious.
Yeah. So let me ask you this. So why are you asking about oxtails? Why are you asking about coconut flour?
Our friend Phil Perlman helped me with the trend or fad question. So he knows something about you.
He does. He does. That's funny.
This is great. JC, thank you very much for joining me. How do people find you?
Go to allstarcharts.com. I'm easy to find. YouTube at Allstar Charts, Twitter at Allstar Charts, StockTwits at Allstar Charts. So, like I said, pretty easy to find.
Perfect. I enjoyed the conversation. Thanks again.
Yeah, anytime. Thanks for having me.
Take care.